Generating 20,000 rupees of passive income every month usually leaves you with two frustrating choices. You can lock your money in a fixed deposit and watch inflation erode your returns, or you can pour massive capital into traditional dividend stocks and hope the market stays stable. There is a third option that functions like a mutual fund for physical, revenue-generating infrastructure. These are infrastructure investment trusts, or InvITs, and they currently offer yields between 10 and 14%. This chart shows a massive disparity in the current market. While standard fixed deposits hover around 7% and the Nifty 50 dividend yield sits near 1.5%, InvITs are pushing deep into double digits. SEBI, the market regulator, enforces a strict legal mandate. These trusts must distribute at least 90%. This mandatory payout leaves the trust with very little cash in reserve. It creates a structural challenge where the fund has limited capital to acquire new assets, manage existing debt, or cover the natural depreciation of its infrastructure. Chasing a 14% headline yield without checking how the trust manages its internal finances often backfires. If the trust can't maintain its assets, your dividend arrives while your underlying capital slowly erodes. To protect your money, you have to look past the yield percentage and evaluate the specific revenue engine driving the trust. We can map these trusts onto a risk matrix, starting with the category offering maximum dividend safety. Our first entry is PG InvIT. Sponsored by the government-backed Power Grid Corporation, this trust owns thousands of kilometers of high-voltage transmission lines. They operate on an availability-based business model. In this model, revenue depends entirely on line uptime. As long as the physical lines are functional and available 98% of the time, the government pays the full tariff, regardless of how much electricity actually flows through them or what the weather is like. This stability comes with a structural trade-off. These assets use fixed-term contracts expiring in 2028. Because the sponsor hasn't added new assets since listing, the trust faces a future cash flow drop, explaining its zero capital growth. You can find a similar level of safety by moving from power lines to roads, specifically through Indus Infra Trust. Indus Infra operates toll roads using the hybrid annuity model, or HAM. This means your primary customer is the National Highways Authority of India. The HAM model eliminates traffic volume risk. The NHAI guarantees fixed annuity payments to the trust, ensuring money arrives even if roads are empty. However, Indus is a young fund. It relies on buying assets from its own parent company and is taking on significant debt to meet its 2026 growth targets, creating a risk profile that is still largely untested. Availability and HAM models are built for a specific purpose, providing predictable dividend safety to investors who do not require long-term capital appreciation. To grow your original investment alongside your passive income, we move to the middle of the matrix, the growth and yield balancer, led by IndiGrid. While many InvITs sit on static assets, IndiGrid uses an aggressive acquisition strategy. They continuously use their capital to buy new infrastructure projects to expand the total value of the trust. Their portfolio has expanded from simple power transmission into utility-scale battery energy storage and massive solar generation fields. This creates a dual-engine return. Investors currently collect a 9.5% yield, while the unit price itself has appreciated 65% since its IPO. This model carries higher execution risk. Management must successfully identify and integrate complex new projects without taking on toxic levels of debt that could threaten the dividend. This category allows you to accept a slightly lower initial yield in exchange for active portfolio expansion that can outpace inflation. Finally, we reach the high-risk toll and debt plays, which include funds like Cube Highways and IRB InvIT. Unlike government annuity models, Cube Highways relies on a pure toll-based structure. 85% of their revenue depends entirely on how many cars and trucks pass through their gates every day. Traffic models provide massive upside during economic booms, but they also mean instant dividend cuts during local slowdowns or regional disruptions. Variable revenue is a known risk, but the most significant red flag in the InvIT space is aggressive borrowing, as seen with IRB InvIT. A trust can take on massive debt to buy new highways, which inflates the portfolio size and makes the fund appear to be growing rapidly. The math is devastating. IRB doubled its debt in 6 months to fund growth. because they must pay out 90% of cash flow, rising interest costs forced a dividend cut to 6.5 rupees, while capital value fell 40%. Ignoring the underlying debt to chase a headline yield results in a rapid loss of your initial principal. Choosing an InvIT means selecting an underlying business model, not just a yield figure on a screen. If you have a high risk tolerance and want to bet on regional growth and rising traffic, the pure toll models or newly listed HAM funds are your primary options. If your goal is to generate income while simultaneously growing your wealth to beat inflation, focus on diversified funds that are actively expanding their portfolios. If capital preservation is your absolute priority, the volatility of equity-listed trusts might be too high for you. In that case, you should avoid toll models entirely and stick to PG InvIT or look outside the trust structure. For those seeking stability, platforms like StableMoney offer direct investment in fixed corporate bonds listed on the NSE and BSE. These provide returns up to 12% with monthly payouts, without the structural risks or contract expiration issues of an infrastructure trust. High passive income is achievable, but protecting your capital requires aligning your specific financial goals with the correct asset mechanics.